for joining us today. Jeff, I just want to ask you a quick question. Your background today looks extremely familiar.
Oh, you don't know what it's
Yeah,
from?
I kind of do. Kind of looks a little bit like a TV show we all used to watch back in the when 90s.
Yeah, it was
Yeah.
I think Seinfeld concluded, I think it was 1998.
Hmm.
And I was a big fan of all the episodes except the finale, and I don't think I'm alone in saying that.
Yeah. So why the background? Today we're going to be talking about asset bubbles. Are we in a bubble today? Is the hype worth it? Does everyone, are we really into a bubble? So tying it into the Seinfeld, or is it a huge hype and trend?
No, no, I just selected photos from the that reminded me of the 1990s. So you've got a movie store and I've got Seinfeld. That's
Yeah,
why.
I remember the blockbusters. Yeah,
Yeah, me too.
yeah.
I missed them. I went to a Rogers video. So, but
Okay.
they were essentially the same. It's funny,
Yeah.
all these things that kids today just have no idea,
No.
uh, what they were like. Not just going to a movie store, but having a landline or dial-up
Yeah.
internet.
Right.
Lots of stuff.
Or even how the video started with Atari and things like that way
Yeah,
back. What's
absolutely.
Atari, Mom?
Yeah.
Yeah. So anyway, let's talk about it. Asset bubbles are really driven by speculation and emotion by investors. So it's almost like if they see a trend of a market or of a particular stock driving up and the price is going up and they think it's going to be a huge success, the hype gets built up and people and sometimes tend to buy in as the price is driving up, which is interesting. We're going to get into that a bit more, but the S&P 500 delivered double digits in 2003 to 2005, exceptional gains. So we're looking at, are we in a bubble today? Why people are thinking that. So when those happen, there's usually a pattern of some sort. So why don't we go through the first part of the pattern, which is abandoning traditional valuation metrics?
Sure. So that was the first trait we looked at. And the two bubbles we looked closest at were the tech bubble in the late 1990s and then the financial crisis in 2008, 2009. And in the tech bubble, we saw a lot of unprofitable companies that went public, and it was impossible to value them because they didn't actually have earnings or they didn't generate positive free cash flow. So to justify the stock run-ups, people started looking at non-traditional financial metrics. So things like a price to earnings ratio or free cash flow yield were ignored. And in the late 1990s, people were assessing things like number of eyeballs that visited a website. They were just looking at website traffic to justify a higher stock price. We're not seeing that in this market. And a great example is the performance of the Magnificent Seven so far year to date. The group, which are large technology companies, they're up about 3% collectively, but the market is up closer to 10%. And the reason for the Mag 7 underperforming is because while their earnings are still strong, the market does not like the fact that they're spending all of their free cash flow, even though it's to build out their AI infrastructure. So, because of that declining free cash flow, that's why the Mag 7 has underperformed. So we think that the market is still looking at traditional valuation metrics. And for that reason, we don't think that this historical sign of a bubble is present in today's market.
Mhm.
So that takes us to the next trait that we looked at, which is extreme valuations. At the height of the tech bubble in the spring of 1999, the market traded at about 34 times earnings. To put that into perspective, the market historically trades between 15 and 16 times earnings. So it got to about double its historic valuation. Today, the market's trading at about 19 and a half times earnings. So it is higher compared to the historical average, but earnings so far this season are quite strong. We're seeing about 47% year over year earnings growth amongst the S&P 500 companies that have so far reported, and it's very high margin. The average margin's about 19 point, pardon me, 16.9%. That's a very high margin. It's the highest margin since at least 2009, and the earnings growth is the highest since 2021 when we were coming out of the pandemic. So I think because we're seeing this high margin, high growth market, a 19 times earnings multiple is not unreasonable. It should trade at a premium if we're growing this strong. So I don't think right now this market is experiencing extreme valuations. Some stocks, though, are trading much higher than they should, but that's always the case. But the overall
Hmm.
market, I don't think is overly valued. So that takes us to our next trait. And Sunny, why don't you take that one?
Euphoria. Yeah. So I guess when stocks or IPOs are built up um, by people and stuff through the internet advertising, there's one particular company that came to mind was Pet.com that did a Super Bowl, spent millions on a Super Bowl advertisement, and created a revolutionary story. And the hype got built up drastically that I guess Wall Street, everyone got on board into buying this stock. But they just, within 9 months afterwards, after the huge buildup, the company went bankrupt. So they were not, they were selling dog food and things like that, but they weren't making a profit.
Yeah. Okay, so Euphoria doesn't look like anything like during the tech bubble. The
Mm-hmm.
next one is a margin buying. So if you were to look at the market that led up to the financial crisis and you were to compare it to the tech bubble, the late 90s was probably about excessive valuation, whereas the financial crisis was about hidden debt in the system. They were different bubbles, but they both shared the same characteristic of margin buying. And that's when people borrow money to buy stock. This
Mm-hmm.
is important because you have to keep a certain reserve in your account. And if the stocks you've borrowed money to buy drop in value, you either need to put more cash into your account or you have to start selling your positions, even if you don't want to. And so if you start selling your positions and others do the same, it can have a cascading effect where people look at the momentum of the market and they say, okay, things are dropping, and other people will sell too. So that's why margin
Right.
buying is important. Um, I look at year over year percent changes in the amount of margin debt in the system. And if you look at 1999, there was a 60% increase in margin debt that year. And then, of course, the market topped out in early 2000. And then leading up to the financial crisis, in both 2020, pardon me, 2006 and 2007, margin debt increased by at least 20% both years. Today, in 2024 and 2025, we've seen margin debt go up by 30% both those years. So, of the traits we're looking at, this is the one we're most concerned about. And so, it's certainly something to keep an eye on for sure.
And
Um,
we should mention that Schneider and Pollock, we don't have any client accounts that are margin.
yeah, that's true. Um,
Right. Yeah.
yeah, and we wouldn't do that anyways, even if someone
No.
asked. So, so we are concerned about leverage. And then this brings us to our last one, which is normally in leading up to a bubble about to burst, there's a flood of new listings in the market. So these are private companies going public and selling their shares to ordinary people. In the tech bubble, there were tons of unprofitable companies going public. In 1999, there were about 447 operating companies that went public that year, and
Hmm.
74% of them had no profits. Since 2022, we've had fewer than 100 companies each year go public, This year, we're running below the 10-year average. And in the first half of this year, about 48 companies, operating companies, have gone public. So we're not seeing a flood of new listings, at least not yet.
Mm,
So I mean, that's our assessment on the market we're in today. Based on those traits we mentioned, I'd say margin debt is a concern, but we're not worried about the other ones. That we're not seeing euphoria. We're not seeing excessive valuations. We're not seeing a change in the traditional valuation metrics, and we're not seeing a flood of new listings. So, if that changes, we'll change our mind. But right now, we're not seeing it based on this
we're not concerned.
assessment.
Yeah.
So,
Okay.
all
I think
right.
we covered everything.
Yeah, absolutely.
All right.
Okay,
Thanks.
thanks.